There is pressure in the broader markets. There's no doubt about that. Now, the mid-cap index is down over 2,000 points from its peak earlier this month. But the one pocket that has been the highlight of the year gone by, even the start of this year, and continues to remain a major talking point in every market conversation we have. No surprises for guessing that one. That is the PSUs. Now, we mentioned yesterday that the Nifty PSE index has already corrected by nearly 6% from its peak. But there are other non-index constituents too that are facing similar stock movements. And I would like to begin with REC and PFC. Now, those are the top two gainers on the PSE index last year. Now, take a look at their last 12-month returns, almost 4x, and in comparison, this 20% correction from their peak may seem pale, but it has happened in a very short period of time. Now, another high-flying sector among the PSUs was the railways, and I'm singling out IRFC and RVNL in this case simply because even in January of this year, both of these names were up over 70%. Yeah, 70% in a month, and that's the kind of moves that we have seen in these stocks. Now, from their peak, both of these names are down by at least a quarter. That's over 25%. The other sector that has been in the spotlight has been OMCs. All of them are down between 10 to 15%, but all three of them have at least doubled in the last 12 months and had their best calendar year in over a decade. Now, same is the case for other power-linked companies too. Here, SJVN has taken the biggest knock from the peak, that is of over 30%, but that also comes on the back of a 250% rally. But can we call this a healthy correction? Well, that's subjective, but the point I'm trying to make here is that despite this 10, 20, 30% correction from their peak, most of these stocks are trading well above their historical valuations. Now, take a look at this. Both REC and PFC are trading at a 1-year forward multiple of 1.5 times. The company has set aspirational targets for itself, that is REC, of 10 lakh crores in AUM by the end of the decade, and with the kind of push the power sector is witnessing from the government, these stocks have surged. And how? But both of these names still continue to trade below their 5-year historical price to book valuation of 0.6 times and 0.5 times. The railways is the other sector where the government has laid massive impetus. Companies like RVNL is getting orders and is expecting companies like IRFC to fund their plans. Now, look at RVNL, still trading at 37 times price to earnings, while the 5-year average is around 17 times. IRFC is also trading at 29 times despite this 25% correction that it has had from the peak. A sector that has ignited massive debate on the street is the OMCs. The street is at the extremes when it comes to evaluating their prospects. There are bulls and there are bears. Now, Nuvama yesterday mentioned that these record-breaking earnings will normalize going forward, but some do not believe so. Yet, barring BPCL, both HPCL and Indian Oil continue to trade well above their 5-year average valuation. Now, the impetus to the power sector will aid power utilities as well. So, Coal India had its best calendar year on record in 2023. The stock made new highs and hence the increase in valuations. Yet, at a 1-year forward multiple of 9 times, some market participants still call it cheap. But the data shows that it is well above the 5-year average of 6 times. Now, look at SJVN, down 30% from its peak, but still trading in double-digit multiples, comparing to a historical valuation of single digits. So, the debate is wide open. Some would justify these valuations considering the road that lies ahead for these companies. But the question is, how much of a dip is too much of a dip?